Hi, this is David from Critical Trading. ATR or average true range is one of the most useful indicators out there. I use ATR quite extensively in my algorithmic trading strategies, and I believe that this indicator can certainly improve a trading strategy if used in the right way. But how exactly do you use it? Well, you're about to learn just that. In this video, I will share with you 3 different ways you can use ATR to improve your trading. So what does ATR indicator actually do? Well, let's have a look at an example chart to answer that question. On this chart, we can see 2 distinct areas, this one and this one. The difference between these 2 highlighted areas on the chart is the size or magnitude of price movements. In the area on the left, the price movements seem to be much smaller in comparison to the size of price movements in the area on the right. The size of price movements is commonly referred to as volatility. The more volatile the market is, the bigger the price swings it makes. On this chart, this can be seen by looking at the size of the candlesticks, such as these 2, highlighted in purple. These are much volatile than these other 2 here. And this is where the ATR indicator comes in. To put simply, ATR measures the size of the candlesticks to determine the volatility of the market. So it pretty much does something similar to what I've just described, but obviously in more exact fashion. So I've applied ATR with a period of 5 below my price chart. We can see that its readings correspond with the changes in volatility visible on the price chart above it. As well as on the price chart, we can see 2 distinct areas on ATR as well. Area of low volatility readings here and area of higher volatility readings here. The increase of ATR readings in this area corresponds with increased range of price movements in this area, and low ATR readings correspond with smaller price swings in this area on the chart. Now, I don't really believe the exact calculation of ATR is that important to discuss here. Instead, what matters much more in trading is knowing how to use it in a practical way, and that's what we're going to cover now. The first way to use ATR to improve your trading is to use it for your stop losses. This is my favorite use of ATR, and I personally use this method in a few different algo strategies that I trade in my own portfolio. The logic here is very simple. You use the current ATR reading to determine the current market's volatility and use this as a basis for your stop loss size. This way, the size of your stop loss dynamically adjusts to the current market volatility, making it more aligned to the current state of the market than using fixed stop loss. I've got 2 levels drawn around the price chart in yellow. Both levels are based on ATR with period of 5, where this value is then multiplied by number of 2. The top level is taking the high of price candle and adds the ATR value to it, where the bottom level takes the low of the candle and subtracts the value instead. The resulting level above and below the price chart is the level of simple dynamic stop loss that's based on ATR and therefore based on current volatility of the market. If I zoom in a little bit here, we can see that the size of the stop loss changes dramatically when the volatility increases. The distance between this candle's high and the stop loss level here is roughly about 15 full points, which in this market translates into $300 per 1 unit or contract. But as soon as the volatility increases, the stop loss level gets plotted much further from the price, and so the stop loss dynamically changes. For example, the distance from this candle's high to the yellow level above it is visually much bigger than previously. It now equals to roughly 35 points, resulting in suggested dynamic stop loss of $700 in this particular market. The benefit of using this method is apparent. It can certainly increase a long-term win rate of your trading strategy. For example, let's say that you sold here at this bearish candlestick that I've just highlighted. You sold at its close and used a fixed size of stop loss. Typically, in this market on low intraday timeframes, this would be around 20 ticks, so 5 full points. Because of this, you would end up being stopped out somewhere around here, just to see the market reversing back to your direction of your trade shortly after. But if you used stop loss that's adjusted to the current volatility, you would end up having a profitable trade simply because your dynamic stop loss would be placed much further from your entry point. Now let's have a look at another method to use ATR. This method is to use ATR to determine a dynamic trigger point to open a trade. On this particular example, I'm going to go over a rough framework of using ATR to trade breakouts in the markets. I've recently publicly shared a mean reversion trading strategy that's using ATR to pick dynamic buy levels. Have a look at this video where I go through it step by step, link in the description. Now, for the purposes of trading breakouts, the logic is that the ATR is used to determine the current market's volatility. same as with the previous method. This is done again by taking the current ATR's reading. A certain multiple of this reading is then taken and is added to the previous day's high and subtracted from its low. The result are two horizontal levels that I have here on my chart. The top one acts as a buy level when the market manages to break above it, and the bottom one is a sell level. What I just described is a very simple framework of intraday volatility breakout trading system, a very common trading method in a systematic trading arena. The logic of this kind of trading approach is to use ATR to determine the standard or expected volatility of the market. If market's volatility remains within the same range, then the market should remain trading in between the stop level and the bottom level. This will translate into the market trading sideways and trading within its normal volatility, shall we say. However, if the market is strong enough to be able to break above the top level, for instance, it would mean that the volatility has risen and it's likely to result in a new trend. In this case, this kind of trading approach would buy, speculating on a breakout and a new trend. The opposite logic would be used to trade short at the breakout below the bottom level. So in this particular method of using ATR, ATR is used to provide dynamic entry levels to trade breakouts. For example, here's a buy entry where this rough system I just described entered long and held its position for the rest of the trading session up until its close, so here. The last method of using ATR I want to present in this video is to use ATR in a more discretionary way when trading manually. This method can be used in quite a few different ways. For example, it can be used to dynamically switch between different size of profit targets or an actual exit technique, but also in between actual trading strategies. Again, the ATR is displayed below the chart. This time, however, we don't really look for exact ATR readings, but instead we want to determine the areas of ATR, where we want to establish what are the areas of its extreme values. So in this particular case, we can see that these spikes in ATR are definitely more extreme than these low volatility areas here, and also here. Now, how do you actually use this information? Well, a good starting point is to look at the current ATR reading and put it into the context of its previous values. The current ATR reading we can see here is roughly about 8, but it doesn't really say anything about how does it stack up against past readings. In order to be able to understand that, you can simply come up with a couple of ATR levels that you use as your reference. So let's say this level and this level. If the current reading is below the bottom level, you conclude that the current volatility is low. If the ATR is between these two levels, the volatility is standard or normal. And lastly, if the ATR is above its stop level, you deem the volatility to be high. But now, how do you actually use this? Well, as I said, there are actually quite a few different things you can do here. What I recommend to start with, though, is to experiment with your exit technique based on the current ATR level. You can do something similar to what I discussed in the first point of this video. You can simply adjust sizes of your profit targets based on the current volatility level. So in this area where the ATR keeps above the top level, it would make a lot of sense to increase the size of your profit targets and aim to catch bigger moves in the market, simply because it now offers higher odds of doing so. We can see how extreme ATR readings above the top level correspond with the strength in the market. Not only was the momentum up sustained for a longer period of time, it was also bigger in dollar terms. On the other hand, price action that corresponds with the ATR being below the bottom level offers considerably smaller movements, and so it would make more sense to lower the size of your profit targets. As I said in the beginning of this section of the video, you're not necessarily limited to adjusting size of your profit targets though. You can go one step further and change your actual exit technique as well. For example, you would opt in for trailing stop loss when ATR is above its stop level. The aim would be to ride a potential trend for as long as possible. On the other hand, when the ATR is below its bottom level, you would not use trailing stop loss at all, but rather aim to exit as soon as possible using much smaller profit target. This way, you dynamically adjust your exit technique to the actual market's volatility using ATR indicator. But again, you can go a step further. You can start experimenting with different entry techniques as well. There are really quite a few different things you can do with the ATR indicator. And this concludes today's video. As always, thanks for watching. David at Critical Trading, signing out.